Hey guys, Toby Mathis here, and today we're going to dive into 1031 exchanges. I'm going to give you everything you need to know about them, 10,000 foot view in 10 minutes or less. So let's dive in. Number one, what is that 1031 exchange? Well, basically it's swapping real estate for real estate. It used to be we could do other types of assets, but Tax Cut and Jobs Act, amongst a bunch of others, limited to just real estate. But here's what it is. 1031 is a code provision of the U.S. Code, so 26 U.S.C. 1031. No gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment if such property is exchanged solely for property of like kind. So what the heck is actually like kind, right? Well, basically it's U.S. real estate for U.S. real estate, or if you're an American, U.S. citizen, it is foreign property for foreign property. You can't do foreign property for U.S. property or U.S. property for foreign property, but you can do any U.S. real estate for any U.S. real estate. And that's territories too. So like you can get into some like Virgin Islands and things like that, U.S. Virgin Islands. But let me draw it up for you so you can actually see it so it makes sense. I'm a visual person, so I'm going to use a fancy-dancy whiteboard. Okay. So the way to look at it is this. Let's say you have any sort of real estate, period, and you sell it. As long as you buy real estate, again, let's just say this is US, and we'll just make this US. That could be foreign for foreign, but we're just going to do US for US. So I sell US property and I buy US property. It can be land, it could be single family residences, it could be commercial, as long as it's investment property, including, a lot of people don't realize this, but your house. So some of you guys have a ton of gain in a house. Hey, I bought in Seattle, I bought in San Francisco, or I bought in Miami, and I bought it for $1 million and now it's worth $3 million. So you have $2 million of gain, and you're savvy enough to know that there's something called a 121 exclusion that exempts a big portion of the capital gain. So maybe you're married and you know, I could avoid gain on 500,000. Fantastic. That's not going to get me very far if I made 200 or $2 million, right? It's only going to cover about a quarter of it. So I'm going to still have a substantial tax of 20% plus 3.8 plus my state on that 1.5 million. So it's like, oof, that's assuming there's no depreciation or any recapture. That property was never an investment property. What you do is you make it into an investment property before you sell it. Now it fits into this little category over here. So we could have duplex, we could have apartments, multifamily, you could have mobile home parks, things like that. Anything that's real estate, if I sell it, then I just have to acquire one or more properties that are the same value, basically. That's all we're looking for, same value. So gets to this thing where if I sell for $1 million and I buy $500,000, I don't get a full exchange. I could exchange a partial exchange. I can avoid tax on a portion of it, but not the entirety. If I want to not have to pay recapture, if I want to not have to pay capital gains, and I sell $1 million worth of real estate, I need to buy $1 million worth of real estate. Now, let me kind of go over how it works. You can't just do this yourself. You have to have an in-between, and that in-between is right in here, and I'm just going to call it your QI. It's a qualified intermediary. A qualified intermediary has to sell the property, put the money into a separate account, can't go to you. And then you have a timeline to buy the property. That timeline kind of looks like this. Like if I was going to map this out, I would say, here's me, and let's say I'm going to sell a property, a single family residence worth $1 million. And I don't want to pay tax on it. So what I do is I immediately go through and I contract with a QI. So I do that so that I don't have to worry, so I can actually execute and get into this 1031 exchange. That QI I'll just put them right here. They're going to end up going into the transaction. So they're going to sell the property. They're going to execute documents with you that allows them to do that. So you're going to have to execute in this agreement. It's generally giving them the authority to sell that. They're going to put it in a separate bank account, the proceeds from this sale. So the proceeds go up into this bank account. Now they're on a timeline, and the timeline looks like this. Make that a little smaller, move it. I have 45 days on a general typical exchange. They call it a Starker exchange. It's a forward exchange, however you want to call it. A run-of-the-mill vanilla 1031 exchange looks like this. You have to identify property or properties that you're going to close on and use these proceeds up here to buy. So you have to identify properties in 45 days. And then you have to close on one of those properties or more. You can be more. I could exchange $1 million and buy 4 condos if I want for $250 each, right? That would work. But then I have to close within 180 days. And so it kind of looks like that. Here we go. The proceeds then go here to the close. And you are down here. Here's you down here going, hey, I never touched the money. That's what ends up happening. The qualified intermediary has to take title on your behalf. And what they're doing is they're basically holding that title separate underneath the agreement so that they can complete the exchange. So you're just kind of doing a easy way to look at this is here's our agreement. We do our purchase and sale through the QI. So they're dealing with the seller. So, so here's you're selling it, but here's the buyer. They're dealing with the buyer. So they do all this and the proceeds go over here. So they're executing all the agreements. You are basically giving them the authority and signing off on that. Once those proceeds are in that bank account and when you close, so I'll just say the day of closing, you have 45 days to identify. Don't worry, your qualified intermediary does the documentation. And then so long as you do that closing within 180 days, you're going to be good. What your CPA is going to do, you're going to get documents. So I'm just going to say your CPA or your accountant, whoever, is going to file a certain document. It's called an 8824, letting the IRS know about the exchange. Now, what ends up happening is your basis in this property. So remember, I sold it for $1 million. Let's say that I bought it for $250, and we'll just call that our basis. I'm not going to mess with improvements or anything like that or depreciation, whatnot. All I know is that whatever this amount is moves over into the replacement property. So we call this, I'll just say replacement property. So that's generally how it looks. I'm gonna make it a little bit simpler now. So here's you. You contract with the QI. QI contracts with the buyer. Buyer puts money into the separate account. So we'll just call this close date. You have 45 days to name replacements. And you have 180 days to close. That's it. So here we have 2 closings here. We have the sale of the old property, the relinquished property. You have the money sitting in an account that's separate. You can't take possession of that money or it's taxable. And then you just have to close within 180 days. Now, some of you guys are savvy enough to immediately go, that could be a problem, Toby, because what if somebody drags their feet knowing that they're going to cause me to fail my exchange? That's why you don't let anybody know you're doing an exchange. Or you don't have to do a forward exchange. You could do what's called a reverse exchange. If you have the liquidity for it, what you do is you do a little bit different. You buy first and you sell second. This is called a reverse exchange. In a reverse exchange, you acquire the replacement property. Now you have 180 days to sell. So if you don't want the timeline pressure and you're sitting there like, oh man, this is going to be annoying. Now, it is possible to do these simultaneously too, where you're literally going to the closing table and you're selling one property and buying another. Qualified intermediary, again, has to handle all the paperwork. But just rare. More likely than not, you're going to be doing the first one, which is called a forward exchange or a Starker exchange. That's what most people know. There's possibility to do improvements. There's possibility to buy and then improve property. There's possibility to buy and then improve the property after as well. You work with your qualified intermediary to give you all your different options there. But for today, for a 1031 exchange, that's the basics, guys. It's not any harder than that. Yeah, there's a little nuances, but that's the basics of a 1031 exchange. Hey guys, if you like this type of information, please subscribe to my channel and share it with anybody that you think could benefit. Thanks, guys.